a huge, like, I don't know, misconception out there that there's this going to be this like huge 2008 like all over again. And there's some really like key differences between like where we were in 2008 and where we are today, when it comes to housing. In 2008, there was a housing crash, right, that affected the economy. You had predatory lending, right? You had adjustable rate mortgages. You had people with no money, no income, no assets, right, getting loans and like all this stuff to buy houses at 110% of loan to value, all of this like stuff, right? They were just handing people money with low credit and to go out and buy houses because they just thought the housing market was going to continue to go up. And when the rates kind of shifted and people couldn't pay their payments and equity dropped and there was nothing left, people just walked away from their homes. There's this huge foreclosure. And with all of these mortgage-backed securities that everyone kind of like bundled up within Wall Street and all this kind of stuff, right? Everything came tumbling down because the foundation was the housing market. Today is very different. Today, we have people who locked in fantastic debt when, they refinance. They have a lot of equity in their homes, right? They are good creditors. They have good credit, and they have good loans with 20% down and all this kind of stuff. It's a very different lending market.
I think this brings us to our biggest topic of today with the tax strategies involvement with the realtors market. There are some changes, but needless to say, houses are still moving. Properties, commercial, multifamily, luxury homes. In fact, we were talking with Rebecca the other day, and 7% from the bank on a luxury home, because more than just a jumbo loan, was it, right? But houses are still moving. Does that mean that sometimes the realtors, as you're bringing out to the spotlight right now, they have to work? They actually have to do work now, where before, I mean, if they could just attach their name to the property and move with it, then they'd get a commission, right?
Right.
Now, yeah, things have more of a normalized process.
For sure.
And regardless of another recession or depression or any of that stuff, or crash, or inflation continuing to go up, or adjusting back down, or what have you, I think that from a tax strategy standpoint, what we need to recognize is that there's still going to be movement. People are still going to be buying, even with higher interest rates. People are still going to be selling, whether the market's moving up or the market's moving down. There's still going to be movement. And it wasn't very long ago. Some people feel like it's still going on. In certain areas of America, it still is. There's some places here in Utah that you can still post on Facebook your property, and you'll have just as many realtors as buyers calling you because they want to be a part of the deal. And then
Right.
property sells, like, before there's an opportunity. That's not like that everywhere anymore. Now, a lot of times people, because of the rush and they get so excited because there's a pricing battle, and so-and-so is offering 50, 80, 100,000 more on the property, what have you, and then it sells. And now they need to consider, well, shoot, there's capital gains. If this was a property that I had a second mortgage on, do I now have a forgiveness of that mortgage, which has a different tax treatment than capital gains? So not only do I pay capital gains, do I pay ordinary income on that? And then also, in addition, there's the Obama tax or the Medicare tax, an extra 3.8%. And then, oh my goodness, did the Mr. and Mrs. Client not realize that the state also will tax, and only a few states out there recognize a preferred tax rate for capital assets, whereas most states just chalk it up as ordinary income. So California being one of the most egregious, oftentimes in the highest 13.3, Pierce? 13.3 additional state income tax on top of all of those properties, to where an individual sometimes, because they're in this, as historically was, they were getting more and more money for the sale of their home or for the sale of their multifamily or their investment property, what have you. They mentally were already spending it on something. It's like, as soon as I get these proceeds, I'm going to go buy what are some of these name brand purses? Yeah, I don't do a good job at buying those for people. So, but other people, they already have like fixed in their mind the Ferrari and all these other things, and then they come out of it all, sometimes receiving the proceeds and the next day spending the money, and then calling their accountant to say, hey, I've spent like half of it, and I kept some of it thinking that I would still have pretty good buffer, pretty good margin, right? And then they come to find out that no, they don't. And all of the tax consequences go in so many different places that now they have to get a loan to pay the IRS. And so like people get caught in these situations simply because they didn't do the math before, and they weren't aware of the different tax treatments that they could be subject to, or of the different ways that they might be taxed, both state, federally, the Medicare tax, and everything else. Whether it's depreciation recapture, as simple as that, or a mortgage over basis issue, which oftentimes is even more detrimental. So that's why we come together. And Brett Swartz with Capital Gains Tax Solutions since 2008 has been doing a fantastic job as a trustee, helping people with what's called a deferred sales trust. Sometimes that doesn't provide the complete and entire solution. Sometimes we must take, if there's a mortgage over basis issue, part of that debt and a little piece of the equity and move it over in a 1031 exchange, which sounds pretty fancy. It allows us to continue to defer the recognition of the forgiveness of that debt to a future date and not have to pay it now, by which now we've got another 5 to 10 years that we can plan on how to offset that income. And then of course, there's a lot of other smaller and more significant, I say smaller and more significant, that sounds like a contradicting statement, but smaller and more significant tax saving strategies that, because we have power over timing, we can schedule them to the most optimized moment. In this scenario for this individual, coming back to the Palo Alto home, personal residence, only a $250,000 offset against the $2,050,000 gain. Sorry, $2,300,000 gain, which left $2,050,000. $680,000 proposed taxes that they would have had to have paid because they did go to their accountant and have an estimation of all of those things, right? We were able to work with their accountant, work with the client. At the end of the day, 0 taxes paid. There were some attorney fees. There was a trust set up. Now they're really good friends with Capital Gains Tax Solutions and their team so that they can navigate the reinvestment of those assets into things that make sense. And they can now move in and out. So let's talk about life after implementing the deferred sales trust. Should they, as they wanted, reinvest in real estate and then sell that again? It's a similar scenario. We can buy and sell, and these taxable transactions or otherwise taxable transactions are continually being deferred. Now, should there be an environment where there's a tax favorable moment, you can take distributions from these deferred sales trusts.
For sure.
And you can take advantage of those moments where, let's say you're not in the highest tax bracket. Well, for capital gains, it's 20 in the highest, 15, and then 0. So if you can qualify for 0, might as well as eke out everything that you can before jumping into the next tax bracket with money and proceeds out of the deferred sales trust and make that part of your plan. I like to compare it to an ounce of prevention is worth a pound of cure. We always hear that. And literally, if you can get some advice before you have these really big transactions from experts who deal with these big transactions every single day. So go and contact your trusted advisor, whoever that person is, even if it's Uncle Joe. And then also reach out to somebody that specializes in what Uncle Joe does not. And bring everyone together so that your most trusted person is there listening with you, as well as all of these other people that specialize in these maybe once in a lifetime transactions. And let's get everybody on the same page. The deferred sales trust is one tool out of many tools that makes a lot of sense for people who are having these less frequent and higher end transactions. So, we've actually had, and I believe Brett Swartz has a video on this, a financial advisory firm, a very large firm that sold for millions and millions of dollars. They did 2 years of due diligence. And so how can a small mom and pop shop, without all of the resources, a very large firm that paid hundreds of thousands of dollars for another legal firm to do due diligence and write an opinion letter about their very specific circumstance? It makes it really hard when you put yourself in their shoes to, I guess it makes it a little bit more understandable why they might say, hey, I cannot recommend this unless they're given the opportunity, which comes back to what you were saying, Pierce. And in the audience, they were asking, when is the best time to get in front of your CPA? Well, as soon as you're thinking about making a decision, because you might need, and I would say on average, we help people wrap their brains, and their advisors, we help them wrap their brains around this in about 2 months, because there has been so many other studies by other people. I mean, if another law firm, very prestigious national law firm, and this large financial services firm took 2 years to do due diligence, I mean, can't you kind of look at maybe some of the work that they did to help you with your decision? As well as, I mean, should you want your own legal counsel, we've seen people get a legal opinion for their very specific transaction for as cheap as $6,000. Oftentimes you're looking at 15 to 20 or whatever, but if you want to invest that kind of money, because you're going to be saving hundreds of thousands in taxes, or in this scenario, $680,000, you want to know that this transaction is good for you. And if you're not being rushed because of a 2-week deadline, if you got 2 to 3 months, you've got time to research all of this stuff. And we, like an open book, we invite everybody to come in, sign a little NDA so that, you know, you don't go try and do it yourself and damage the recipe, so to speak, but that we let other chefs into the kitchen to see us cook. And we'll gladly educate everybody on all of the processes and all of the procedures and all of the steps. We'll put you in front of the brain surgeons, the tax attorney, the very tax attorney who created this 26 years ago, we have access to and have on retainer. So that's just one out of many strategies. Now, Pierce, sometimes this solves maybe the bulk majority of the transaction, but not all pieces of it. So sometimes this is like the keystone strategy, of which there may be restructuring. We may have to go through the different entities, and to reinvest the assets, we might have to do joint ventures. And to solve the entire problem of today, if there's a mortgage over basis issue, we might need to do a partial 1031, which also means that we might have to find a financial project willing to accept some of that debt rollover so that it's not taxable now. In addition to all of this, we like to optimize. We work with wonderful people like Tina so that people learn how to employ their children. They learn what the Augusta strategy is all about. They learn how to do all of these other things, which are like your day-to-day winning in the margins, which still improve your taxable scenario greatly. And so it's not a one day all done. When we meet with people, a lot of times this is something where, well, we almost have to end up becoming friends because we see each other that often.
Yeah.
A couple times a year, or even more frequently, depending on the number of transactions that they have.
And so having a holistic view of the entire picture, I think, is super valuable. And it's just, it gives a better all around approach. And that's where I think having a really strong team is super important, because without it, and teams that communicate with each other, right? If you have a CPA who's not talking to the estate planner, who's not talking to the real estate attorney, right? Like, you can do a whole bunch of stuff on one side, just blow everything up on the other side without having any idea what's going on. So, I mean, like, you get everyone together and it's like you take an x-ray of their situation. You're just like, you got broken bones all over the place, man. Like, we got to fix this thing. So it's just, I think that's a really important thing, is to surround yourself with those people.
We do have to wrap up. We are next to the top of the hour. And if individuals would like to see more of the tax saving strategies that we have available, there are brief descriptions of all of these on the website, strategictaxsolutions.com. There's also a booking tab, and there's an 800 number. If you'd like to know who it is that you should be talking to about each of these individual strategies, reach out at 1-800-773-1848. Thank you again for everyone who participated. Tina, thank you so much. Pierce, thank you for being here today with us.
Thanks for having me on.
We look forward to you on future calls. And again, I want everyone to have a fantastic week. If you'd like to see something specific, feel free to reach out. We have a comments box. We have an area where, if you'd like to learn more about a specific topic, we kind of choose what to talk about based on what people are asking for. So if we get 5 or 6 or 10 people asking about one thing specific, we move it up on the urgency list and we go over it on one of the future calls. So please call, text, write. Let us know what your thoughts and feelings are about today's broadcast, and talk to you soon. Thanks, everyone.
Sounds good. See ya.